I need to tell you guys about the exact moment I realized my expensive finance degree was basically a piece of paper when it came to actual real-world wealth. I was sitting at my desk fresh out of university, looking at my first investment account, feeling like an absolute genius, like I had finally cracked the code to the matrix and was on my way to Easy Street. I had just bought into these flashy ETFs because that is what all the cool kids on the internet were talking about, and I thought the ability to trade them 24/7 was a massive flex. But then a few months later, I noticed something that made my stomach absolutely drop, which was a tiny detail about how my money was actually moving, or more accurately, how it was getting stuck. Oh shit, I realized I was spending more time staring at flashing red and green numbers on my phone than actually living my life, and that tradability I loved was actually a trap. I learned the hard way that ETFs were missing this one specific automated feature that is literally the secret sauce to building $1 million net worth without losing your mind. I ended up having to sell every single thing I owned, move the whole bag into index funds, and deal with a massive tax and paperwork headache, just to fix a mistake I should have seen coming. I want to save you that exact stress and that wasted time, because honestly, the financial industry loves to make this sound like rocket science so they can keep charging you. If you have been mixing up mutual funds, index funds, and ETFs, please do not even trip, because most people out there are just guessing and hoping for the best while the banks laugh. We are going to dismantle the confusion today and figure out exactly which one of these vehicles is going to carry you to the finish line without breaking down. But before we dive into the deep end, do me a huge favor and hit that subscribe button right now, because this channel is your shield against the nonsense. We are talking real money, real strategies, and zero fluff, so make sure you are locked in for the weekly gems, because I am not here to gatekeep this stuff. Let us kick things off with the granddaddy of them all, the mutual fund, which has been around since the literal 1800s, back when people wore top hats and rode horses. Back then, some smart people realized that if a bunch of regular folks pooled their cash together, they could play the game just like the ultra-wealthy elites. The first major win with a mutual fund is pure convenience, like getting a prepackaged gourmet meal instead of buying 100 different raw ingredients. If you wanted to own 100 different stocks on your own, you would have to sit there clicking the buy button 100 times and paying a commission fee on every single one. That is a massive waste of time and energy that nobody in their 20s should be dealing with, especially when you could be out building a business or enjoying a coffee. But with a mutual fund, you make one single purchase and boom, you instantly own a tiny slice of hundreds of different companies, all in one neat box. That leads us straight into the second big flex of mutual funds, which is diversification, the ultimate don't put all your eggs in one basket strategy. If you put all your life savings into one hyped up tech stock and that company crashes out or gets hit with a lawsuit, you are officially cooked and back at zero. But in a mutual fund, if one company tanks, you barely even feel it because it is only a tiny fraction, like 1% or less of your overall empire. Most mutual funds hold at least 90 different stocks, giving you a safety net that is almost impossible to build by yourself if you are starting from a regular paycheck. The third benefit people always talk about is professional management, where some super smart guy in a suit supposedly picks the winners for you. It sounds great on paper, like having a personal chef for your money who knows exactly what ingredients are going to explode in flavor next year. But this is where the story takes a dark turn and where most people get absolutely wrecked without even realizing it until it is too late. See, these professionals are not working for free, and they charge what we call active management fees that are basically legal robbery disguised as service. We are talking 1% or even 2% of your entire account balance every single year, regardless of whether they actually make you a dime or not. Think about that for a second. If you have $10,000 invested, that guy is taking $200 right off the top just for sitting in a fancy chair and making guesses. Even if the market crashes and your portfolio drops by 20% and you are losing sleep, that manager is still getting paid millions in bonuses. Over 30 or 40 years, those tiny-looking fees can literally eat hundreds of thousands of dollars out of your retirement nest egg that should have been yours. Oh shit, when I first saw the math on how much fees compound against you over a lifetime, I almost threw up in my mouth because it is that predatory. Most actively managed mutual funds are a total scam because they rarely ever beat the market average anyway, so you are paying premium prices for basic results. Then the hero of the story finally entered the chat, a guy named Jack Bogle, who got so tired of seeing regular people getting ripped off that he invented the index fund. This changed everything forever because index funds are passively managed, meaning there is no expensive genius in a corner office making high-stakes decisions. Instead, the fund just follows a fixed math formula based on an index, which is just a representative sample of the whole entire stock market. Think of an index like a quick health check for the economy, like the S&P 500, which tracks the 500 biggest and most powerful companies in the United States. Jack Bogle's first index fund in the 70s just mirrored that S&P 500, and since no one had to pick stocks, the fees dropped to almost nothing. We are talking 0.04% in fees, which is literally peanuts compared to the 2%. The old school mutual fund guys were charging. It is important to remember that all index funds are technically mutual funds, but not all mutual funds are index funds because of that management style. You can spot them easily because the name will literally say index fund in big letters, and the prospectus will talk about tracking a specific benchmark. If the description says the advisor independently selects stocks or uses a proprietary strategy, that is your signal to run the other way because the fees are coming. Now let us talk about the ETF or exchange traded fund, which showed up about 15 years later and started a whole new debate in the finance world. ETFs are almost identical to index funds in terms of what they actually own inside the box, but they have one massive structural difference in how they move. With an index fund, you can only buy or sell shares once a day after the market closes at 4 p.m., which keeps the whole process very calm and steady. But ETFs trade exactly like individual stocks, meaning you can buy and sell them every single second that the stock market is open for business. A lot of people use the terms index fund and ETF interchangeably on social media, but they are not the same vibe or the same strategy at all. You have to ask yourself a very serious question. Do I actually need the ability to trade my retirement account at 10:30 a.m. on a random Tuesday? In my experience, that 24/7 tradability is actually a curse for most regular investors because it triggers our primitive lizard brains when you can watch your fund tick up and down on a chart all day. Every day it encourages you to gamble and make impulsive panic moves based on noise. Human nature is wired for survival, not for the cold logic of the stock market, and we tend to crash out when we see big red candles on a screen. I personally think ETFs do more harm than good for beginners because they turn long-term investing into a high-stakes video game that you will eventually lose. If you are not sure which way to go, I am telling you right now, just choose the index fund and do not look back because simplicity is wealth. Most of us only need to buy our shares, hold them for 30 years through the ups and downs, and then sell them when we are ready to retire. You do not need the fast twitch trading ability of an ETF unless you are trying to be a day trader, and we already know that 90% of those guys go broke. But the real reason, the absolute massive reason I moved my entire portfolio from ETFs back to index funds is the automatic reinvestment feature. This is the ultimate hack for lazy wealth building, and it is the only way I have been able to stay consistent while building my own business. With index funds, you can set up a recurring monthly deposit from your checking account for, say, $500 or $1,000 every single month. The fund will automatically take that money and buy more shares for you at whatever the price is without you ever having to log in or click a button. It is a set it and forget it system that builds your empire while you are sleeping or traveling or working, and the best part is that it is usually free. ETFs usually do not let you do this as easily, meaning every single month you have to manually log into your brokerage and check the current price. Then you have to place a limit order or a market order, and that opens the door for you to start second-guessing yourself and your strategy. You might say, oh, the market looks a little high today, maybe I will wait until next week, and suddenly you have stopped your investing momentum entirely. Who wants to do more manual labor and pay more commissions just to stay on track, when you could have a machine doing it for you for free? When I realized I was missing out on that automation with my ETFs, I knew I had to make the switch because I know my own human psychology is flawed. I know that if I have to make a choice every month, I might eventually make the wrong one. But if the machine does it for me, I am guaranteed to win. So to recap, the whole journey for you, mutual funds gave us the idea of pooled investing and diversification, which was a great start for humanity. Then index funds gave us the revolution of low fees and passive management, which allowed regular people to actually keep the wealth they were creating. And then finally, the ETF came on the scene, which gave us tradability, but also brought back the temptation to gamble with our futures. I am choosing the path of least resistance and the lowest possible stress every single time, which is why I am an index fund fan for life, and I think you should be too. There is a certain peace of mind that comes with knowing your money is working in the background, and you do not have to be a slave to the charts. The world out there is messy, and the economy is always going to be doing something crazy, but as long as you have this shield, you are going to be just fine. If you have questions about which specific ticker symbols like VO or VTI or VFIX you should be looking at, drop a comment below right now. I am always in the comments answering you guys because I want to make sure we are all growing our bags together and not leaving anyone behind. You can also find me on Instagram at FayInvestingWithRose if you want to see the behind the scenes of how I am actually managing my own six-figure portfolio. I post a lot of stuff there that doesn't make it to the main channel, so come hang out with the community over there as well. Always remember to go after your dreams unapologetically and live this life on your own terms because nobody else is going to do it for you. You have the knowledge, now you have the shield, and you have the plan. So there are no more excuses for staying on the sidelines. I will see you in the next video where we dive even deeper into the strategies that actually move the needle for our generation. Take care of your money and it will take care of you when you need it most. Peace.